Hello, everyone. Thank you so much for joining. We're just going to give it 1 minute here for everyone to join into the Zoom, and then we will get started. Thank you so much for being here. Okay, great. Thank you so much to everyone for joining the webinar today. We're grateful for your time, and we look forward to our discussion on navigating the new FSA farm loan changes for Native producers. So earlier this month, the USDA Farm Service Agency announced improvements to the farm loan programs, which are part of the Enhancing Program Access and Delivery for Farm Loans rule. So these changes are set to take effect on September 25th of this year. So our team at the Native American Agriculture Fund and the team at the Native Agriculture Financial Services wanted to provide a space for Native producers and those of you who work directly with Native producers to have a chance to learn about what those changes are and how they can enhance financial freedom, resilience, and profitability. Today, we're also grateful that we have the Farm Service Agency Administrator, Zach Ducheneaux, joining us today. The team at FSA is working diligently to roll out these changes with all of FSA. So them taking the time to prioritize joining this webinar shows their commitment and dedication to supporting Native producers. And so we're grateful for your time. We have time also set aside during this webinar for questions. So we encourage you to submit your questions via the chat box, and our team will monitor those, and then we'll answer those as we go throughout the webinar. This webinar will be recorded, so if you need to reference it at a later date, the link will be emailed to you following the webinar today. With that, we can get started, and I would like to first introduce Tony Stanger McLaughlin, the CEO of the Native American Agriculture Fund.
Hello, everyone. And thank you for joining us today. And we are so grateful for our partners at Native Ag Financial Services, as well as USDA, for joining today as well, so that we can share this valuable information. A little bit about the Native American Agriculture Fund. For those of you that are new to this space, we are a philanthropic drawdown trust fund, which is a big way of saying we make grants to Indian country for agricultural purposes to advance the needs of Native American farmers and ranchers and harvesters. NAF was created as a result of the Keepsego v. Vilsack class action litigation, and those were producers who were either denied loans or provided poor loan servicing at USDA. So the foundation of who we are as an entity exists to reduce or eliminate the original harms of those claimants. And so hearing about the changes in this administration, we're so excited about the support of the Biden administration to pursue or allow for the administration to continue the work in this space. But it goes to the heart of who we are and what we're here to do. And so advancing this work within the administration was something that we are proud to have Administrator Ducheneaux explain today. And one of the quotes that he had in a previous meeting with him, he said that this work would have continued with or without him. He brought this in with a personal lived experience, and I think that was really important. But a lot of this work, he echoes that others in the department will carry. And so knowing that, it gives us a lot of confidence working with this administration, with USDA and the Farm Service Administration. These changes have been in the works for many years, and for this to be the first time to have actually a producer come in with his lived experience to explain why these aren't working, and especially why these aren't working in any country, has been so important. So with that being said, I'm going to introduce to you our guest speaker today. Thank you again for taking time out of your day to work with our constituents, with our grantees and the communities that we serve. But I'm going to hand it over to Zach Ducheneaux to talk about these changes and how they're going to impact you.
Thank you, Tony, and thank you to everybody at NAF and NAFS for giving us this opportunity to visit with our friends in Indian country about the importance of this rule and the why behind it. So as all of you may know, I'm a child of the farm financial crisis, and my formative years were spent living in a family that was under distress, and I'd watched my family's livestock load up on the truck for the last time back in the 80s during all of that. And I got my first professional experience as a distressed borrower who needed a job as a farm advocate at the Farm Service Agency, helping Native American producers in the North Dakota, South Dakota, Montana area navigate out of that farm financial crisis. Learned a lot about the Farm Service Agency, then the FMHA then, and have been honored to be able to serve as your administrator for over 3.5 years now. And I do want to just call out the point that Tony made. If I had dropped off the face of the earth a year ago, the career team at headquarters at USDA would have taken this across the finish line without me. There is so much buy-in in this, in leadership, that this thing has its own inertia now. It has its own momentum. We're all here together in Houston, Texas, with a few hundred of our farm loan staff from around the country and a handful of our cooperators in the nonprofit sector who are taking part in this training together for the first time that we know of. This is, the cooperators are in the room taking the training with the staff. And it's because this rule is such a transformative opportunity. And there's 3 main components that I want to call out today in this rule. But before we get into those, I want to talk about the mindset shift that this rule is really signifying. This administration acknowledges the sins of the past, the wrongs that we've done to people. You can see that as evidenced in the fact that we worked with Congress and were able to deliver the DFAP program and make payments to producers, financial assistance payments, not justice payments, financial assistance payments based on discrimination. This administration has also taken a position with regard to farm policy as it pertains to distressed borrowers, to help distressed borrowers get to this point with the 006 funds that our good friend Scott Marlowe and his team have been working on with our farm loan programs team to help keep producers going until we could get here. And this signifies the acknowledgement of all of that, commitment to change, and then a team of folks that have dedicated themselves to implementing that change. Our goal here is to help our staff understand that they are supported in exercising their discretion to the benefit of producers. Oftentimes in the past, they've been painted into a place where they may feel that their only choice is to exercise discretion to not make that loan. We're using this opportunity to change the rules as they pertain to farm loan programs to really empower our staff and make it clear to our producers what they can expect from our staff and their discretion. Before we get into the particulars of the rule that I want to call out, I do want to ask all of our colleagues and stakeholders on the line, be patient with us because this is a significant shift in policy for our staff. It's so significant that we announced the rule with an effective date 6-7 weeks after the announcement so that we have time to get our staff implemented and trained and ready to implement the rule come September 25th. We're trying to get that at the front end of the busy loan season this fall. We're going to need feedback from all of you in the field as to how the implementation is going. As always, we'll have an open door policy at headquarters. We want to know if our staff need more support and more guidance in exercising these flexibilities. And we will certainly work to help in any case where we identify that it may not be landing the way it's supposed to. As you come into the county office after September 25th, be patient, offer grace, offer the same patience and grace that you would like and that you can come to expect under the guidance of this new rule. Another of the aspects I want to touch on real quickly, we have really strengthened our cooperator network. And part of having those cooperators here is to ensure that we're broadening the network of folks that are providing kitchen table technical assistance to producers so that when they get to the office, they know what they can expect. They know what's available to them, and they've got an advocate in the room with them as they engage in these conversations. And hopefully we'll have the loan application all prepared and can come in there with some certainty as to what can be expected in that transaction. If you look at the 3 bullet points on the screen right now, I'm going to start with number 3 because that's the newest aspect of this, and it's kind of a derivation of an existing program that we have to offer. Some of you may be familiar with the disaster set-aside program. When there is a natural disaster, we can offer a producer a chance to set aside a payment to the end of the note and continue their operation. What we've learned from that is sometimes that's all a producer needs. Between that and the distressed borrower assistance, a lot of our producers have really found their footing and are really on a pathway to prosperity. But we shouldn't wait for a natural disaster to trigger that. There are other circumstances beyond the control of the borrower that may trigger the need for that set-aside. The disaster set-aside program, when we set it aside, it accrues interest at the agreed upon rate. Current rates are around 5.5%, 5.6%. So if we were to use the disaster set-aside program, set that payment aside, it's going to continue to accrue interest at that rate. With the distressed borrower set-aside program, because of the opportunity afforded with the 22006 funding, we're able to set that payment aside without a natural disaster, just with the producer coming in and demonstrating that they're going to have some challenges making that next payment. We move that to the back end of the note. It accrues at a rate of 0.125%. So it won't really function as a debt time bomb out there for producers that they're going to have to worry about. It'll just feel like another payment. It can really help reposition things. It's going to be a lower documentation for the producer. It's going to be a lot of work for our staff because our IT systems are working to catch up to our policy work. And that's an ongoing challenge for the agency, but one that we want to make sure that we don't make the producers wait on. So our staff are going to have to do some paperwork on this. We acknowledge that. We appreciate that. And again, ask your patience as we roll that out. The next, I'm going to go in reverse order since we started there. So number 2, lower collateral requirements. More times than I can count. And many of those times in the formative processes of the IACCA network, or even before that in the working group that led to the creation of the Intertribal Ag Council, where I got my start, you would hear Indian producers talk about how they have to pledge every single asset that they've got just to get the loan. And our team did a deep dive analysis on how we securitize loans and our collateral requirements. Our current guidance that will be changing on September 25th is that we will take up to 150% of the value of our loan in security. In a lot of places in the country, we have misinterpreted up to, and we have interpreted it to mean at least 150%. So we would take 150% or more. Our team found that we don't ever need that much security to protect the taxpayer's investment in this transaction. Because of that, we are lowering the security requirement on new loans after September 25th to not more than 125% of the loan value. That is a fundamental game-changing reality for a lot of our producers because it's going to put them in a way different position when they do go out and try to engage in relationships with commercial creditors or some of our innovative friends in the CDFI industry that are trying to fill those voids in the credit deserts of Indian country. If you have assets to pledge that aren't already encumbered by another lender, you go into that conversation as a stakeholder. Instead of being a price taker, you can take your assets and go pledge them at the bank next door and say, that guy wanted to do this, I want to shop here. We're really empowering our producers all across the country to take advantage of the assets that they have beyond our 125% security requirement. Another of the changes with regard to security requirements for producers that already have a loan with the Farm Service Agency, after 3 years of payments as agreed, we can release security down to not more than 125% of the loan value. So producers on both sides of that effective date are going to be able to take advantage of this. It's just going to be in a little different way. Fantastic work by our team to implement this and to put it in terms that our staff and our cooperators can easily uptake this. And we look forward to sharing more of that with you all in the days and weeks to come. The last and arguably the most important of these is supporting financial savings with flexible repayment terms. In the implementation of our statute, Farm Service Agency has taken an approach based on credit elsewhere and not really considered what impact the terms of that credit elsewhere might do to a borrower's profitability or production income. And then FSA has taken an approach that instead of using the building of assets and the accumulation of working capital to grow equity, our pathway for growing equity has been to claw back that principal at the fastest rate that the producer can stand it. The reality of those two dynamics is that oftentimes we hear our producers say, FSA keeps me screwed down so damn tight, I can't operate my business the way I need to. Not only have they got everything I've got as security, but I have to have a job off the farm or off the ranch just to be able to pay for my family living, just to be able to afford health insurance, forget about setting up a retirement account, and how the hell am I going to educate my kids? FSA has the flexibility in statute to offer terms that can help producers meet their actual needs. And what we're training our staff to think about is that the actual needs of a producer are really very similar to what your actual needs are when you take your paycheck home. Health insurance comes out first. Retirement money goes into your IRA or your 403B or whatever it is. You might set up an education fund for your kids. Think about how important those three aspects of take-home pay are. And think about why young producers are leaving the farm. First, they've never seen their folks be able to afford to just do the things that everybody else can do, because their folks are working 40, 60 hours a week off the farm, off the ranch, and then trying to just ranch on the weekends and then the evenings and then the mornings. Why would a kid want to come into that and be part of that? The next challenge we've got in Indian country is that ever-aging population of producers. It went up again in the last census. And the reason that that continues to increase is because we don't have meaningful succession plans, because the succession plan right now is the next generation takes on the debt of the previous generation because they've never been able to get ahead. If we're able to help producers now start to build a retirement fund through their production income because of the terms that we can offer, we're really starting to move the needle towards that. And I always like to leave off with this last one. The prospect of being able to set up an education fund from your production income So your kids know, hey, because we were farming, because we were ranching, because we were growing these vegetables, because we were foresters, you have the money to go to school. And that operation supported you in that. And if that younger producer, that aspiring producer knows that as they leave for school, they're going to be thinking, man, I want to learn more about that so that I can go back and continue this tradition, continue this legacy that my family has started by sending me to school with production income. We have the opportunity to fundamentally change the paradigm in this by implementing these tools. Any one of these on their own would mark a substantial change. But taken together, they're a very strong signal to everybody in Indian country and beyond that the FSA is going to do business in a different way right now. And before I wrap up these comments, I do want to highlight that this is part of a bigger commitment that this administration has taken to reimagining ag finance. And for those of you that are budget or policy wonks, take a look at the president's budget for fiscal year 2025. Within that budget, you'll see 12 legislative proposals that really would seek to solidify and even enhance what we're doing in this rule by getting rid of some of the arbitrary limitations that our farm loan programs are forced to live within. First and foremost, getting rid of the term limits that keep producers from taking advantage of our farm ownership loans beyond 10 years. We're suggesting to Congress that that is a policy that could stand improvement, and we don't see a value in that policy. It should be waived or eliminated. Another of the provisions that's critical for many of our producers in Indian country is overturning the policy right now that's the forever ban, the lifetime ban. If you've ever had any debt forgiveness, you are not eligible for farm loans. What we've advanced in the legislative proposals is that after 7 years, if you otherwise qualify and are otherwise eligible, you can come back in the door and pick up and go back to farming or ranching again, because we find a lot of our producers, despite having that debt forgiveness or write down, stay in farming or ranching somehow and still have capital needs. Take a look at those 12 proposals and look at them in the context of what we've advanced as the mindset change with this rule. And you all have a role as citizen stakeholders in this country and this democracy to advocate to your congressional delegation if you think that's something that's worth your time. Another of the things that we're trying to do with all of these credit reforms is take our subset of producers that need financing and use them as an example of what can be when finance is done at terms that meet the needs of the producer. Our direct farm ownership loans operate at a negative cost to the taxpayer. And I always say that twice for effect, because to have a program that does so much good, helps young, beginning, underserved, socially disadvantaged producers with the largest capital acquisition of their farming and ranching career, and to have it operate at a negative cost to the taxpayer is unheard of. We should do more of that. We should continue to advocate for that. And with the work that we're doing with regard to credit reform, we hope to prove to the rest of the lending industry what many of you all are seeing in the innovative lending spaces that CDFIs are finding themselves in now. When terms are done to meet the actual needs of the producer, everybody prospers. The producer is more profitable. The program is stronger. The performance of the portfolio grows, and our rural economies can then be beneficiaries of it. Having those flexible payment terms and that collateral freed up for those producers to take to a commercial lender, to a CDFI, fundamentally shifts the paradigm from where a producer is currently just a price taker in those conversations to where they can have actual strength in a negotiation as they try to get terms from their local creditor. So we're really proud of the work that the team has done. Houston's on the call. Bill Cobb is our outgoing Deputy Administrator for Farm Loan Programs. We've got a lot of folks at headquarters, a lot of folks in the countryside that have just been waiting for this opportunity to be more flexible, be a better partner for you all. And we're really hoping to look to our cooperator ecosystem that's represented here to help us in that, so that our producers can hit the ground running when these opportunities present themselves September 25th, 2024. I do want to call out one specific thing with regard to the distressed borrower set-aside program, and then if we've got time for questions, I'd gladly entertain them. The distressed borrower set-aside program, because of a funding anomaly, is only available to producers who have a loan with us as of September 25th, 2024. That's not to say that if we had a successful effort to advocate for appropriations to expand that program could expand to new loans as well. But as of right now, it's only going to be available to those that have a loan as of September 25th, 2024. Those are the high points. If there's some questions about it, we can get into some of the more nuanced details, but I'm really proud to have been able to be part of this work. And I want to make sure that proper credit is given to our headquarters team, because they have worked their asses off for the last 6 months to get this across the line. And we can never show them enough appreciation for the way they have improved the lives of producers with this rule.
Great. Thank you, Zach. So we're going to move into questions, but before we do, I want to give a moment to Rich Howe, Legal Counsel for Native Agriculture Financial Services. So Rich, I'll turn it over to you. And just as a reminder to folks, you can submit your questions via the question box. I think I misspoke earlier into the chat function, but if you have any trouble, feel free to reach out to our staff and we'll try to get you in the right direction. So Rich, I'll turn it to you.
Thanks, Whitney. Like Whitney just said, I'm with Native Agriculture Financial Services. We are a 501c3 nonprofit organization that's currently in the process of becoming a other financing institution within the farm credit system. And I think just generally, we at NAFS are very in support of everything that Zach is doing at FSA. We've had the opportunity to work in different capacities over the years with FSA, and we think that these changes are something that's going to really support producers on the ground and give them flexibility in ways that we also hope to give a little bit further down the road within our own operation. Thanks, Whitney. I'll hand it back to you.
Great. Thank you so much. One of the first questions that came in, kind of a in the weeds question, I think, but what is the limit of number of payments that can be set aside?
That's a really good question. And as luck would have it, I just sat through that particular training session here. So the standard limit is going to be 3 years of interest-only payments to start a term loan. Producers can opt for less. 1 year of interest-only payments is virtually automatic. We want to empower producers to be part of these decisions, so they have the book is open to them. In other circumstances where there is demonstrated need, say you're establishing a olive orchard or something that takes more development, with the proper justification, additional deferral periods can be considered, but 3 years is going to be the norm. It's a really good question.
Great. As a producer, what steps can I take to prepare for these changes?
The best step a producer can take is to, at least once a year, compile your financial statements and put together a projected cash flow, whether you need it at that moment or not, or whether you're getting financed somewhere or not. Having that information ready to be able to use when you need it is the most critical first step. Our cooperator network is standing ready to help you all with that. And we're working to improve on that cooperator network by standing up a broader network within the extension and risk management education network, specifically targeted in the south or the northwest part of the country in Indian country, and in the southeast part of the country where a lot of our Black farmers are. But having your financials ready, understanding your financials, and being able to explain your operation over the course of the year are invaluable tools for producers. Another item to gain familiarity with is amortization tools. Take a look at what payments you can afford. Take a look at what your retirement needs are, what your working capital needs are. The more prepared you can be when you start these conversations, the quicker our team is going to be able to get you processed and get you in the queue to get the capital you need.
Great. So another question that came in was, are there any new loan opportunities for Native producers, or what are some of the changes specific to Native producers?
I mean, could you repeat that? You broke up a little bit, Whitney.
Yes, yeah, no trouble. Are there any new loan opportunities for Native producers, or any specific changes for Native producers through these updates?
These are all fairly broadly applicable changes to the entire program. They will naturally benefit Indian producers and take a lot of the questions and concerns that Indian producers have had over the years off the table. The lower security requirements, the more flexible payment terms. One that I maybe went over too fast. We're not going to take the primary residence as additional security. If we can secure our loan without that, we will sever that off and the home is safe. So in those times when circumstances dictate that a producer may not be able to continue farming or ranching, they'll at least know they're still going to have a place for their kids to live. So that's another big change. And all of these come from a catalog of suggestions that date back to the working group days of the IAC, through the farm crisis of the 80s, the litigative stages in the 90s and the 2000s. All of the feedback that we've heard from producers over the years has landed, and we have started to implement the changes for that with this rule.
Great. We have a couple more questions coming in. And I just want to remind folks that there's a lot of really great information in this webinar. So it will be recorded. It is being recorded right now. We will send out a link to the recording following today's webinar, so you'll have access to reference this at a later time. One other question, just to clarify, with the changes being made to the flexible repayment terms, borrowers can put aside income from production to go towards any savings account. Is that correct?
That is correct. And we will have the fundamental premise of this is improved communication. So our staff are getting trained right now as we speak to engage in that conversation and really help the borrower better be able to articulate what their long-term goals are. And we will build the terms of the loan to help the borrower meet their long-term goals, instead of just saying, oh, you want to do a cow loan, we're going to give you a 5 or 7 year loan. That's it. We're opening the book on loan servicing sooner so that it's a planning tool instead of just a recovery tool.
Great. What can nonprofits or CDFIs or other organizations do to support producers who are going through these new changes?
I think to support the producers as we transition in this, familiarize yourself with the rule. We can get you all some training materials. If you're interested, reach directly out to me or any of our team on the call here. we're willing to share those materials so that you're well versed in what we're doing, and then communicate it with producers. Another important part of this is to continue to make sure that our friends that authorize and appropriate our programs hear support for this. If you're in support for it, let your congressman know. Take a look at the legislative proposals. Take a look at your all's policy books on what you're advocating for in the Farm Bill. And if they fit, add them to your platform so that your friends that and colleagues that you're working with on the Hill as you talk about Farm Bill initiatives are hearing directly from you why these changes will benefit. Some of the things that we're going to do to help in that is continue to work with our team to put out examples, real producer examples of what some of these changes mean so that we can see it there in black and white. Because if you choose to take up your right as citizen stakeholders and advocate to your legislators, it helps to have those examples that are based on real circumstances for producers.
Great. Another question that came through was asking about if you could speak to ongoing support to build farming, support farming and settle with those that have gone through the civil rights matter. Could you speak to that a little bit more in detail?
Yeah, I think a good way to look at this rule is that we have heard the pain points in Indian country and elsewhere that have led to that set of circumstances where discrimination happened or where civil rights were infringed upon. And in many cases, that happens where there is discretion on the part of the staff and they don't exercise it to get producers in the door. What this rule does is lets our staff know that you're supported and expected to use your discretion to get people in the door and give them the best deal that we can at the beginning of the relationship instead of waiting until things get into distress and then we're not dealing with each other from an open and friendly communication. It's under duress. I think it's important to highlight the fact that as we think about some of the things that have occurred in the past, it's been under the color of discretion. And many times when our producers get an unfavorable decision based on the discretion of a loan officer, they can appeal it to NAD and they lose at NAD. Because if that loan officer has discretion and they're just exercising it and exercising it in a way that may be too conservative or too restrictive, it's still their discretion to exercise. What this rule does is really lays open what the discretion is, helps producers know what they can ask for, but understand there are some things that we can't transcend. We have statutory limitations. For example, I've got a friend out on the Pine Ridge Reservation who came to me very early on. He said, I got told that I'm not eligible for a real estate loan. Well, that doesn't sound accurate to me. Let me check. And that's that statutory prohibition on getting a loan more than 10 years after you've gotten the first one. That's one of the important parts of the legislative proposals and how they fit into all of this. It's a holistic approach that we really hope that we get enough time to move further down the road. But this rule goes a long ways towards institutionalizing this approach to the benefit of all of our producers and hopefully forestall any future civil rights or discrimination cases.
Thank you, Zach. I have another question that I think gets into the weeds a little bit here. But according to the direct farm ownership down payment loan, as established by the beginning farmer definition, loan applicants interested in down payment loan may not own more than 30% of the average size farm at the time of the application. The applicant may exceed the 30% after the loan is closed. The question is this based on the state or national average farm size?
That would be based on the average farm size locally there. It wouldn't be the national average. It wouldn't, because the average farm size in Indian country is well over 1,000 acres. In Maine, for instance, it's probably 50 acres. But it's based on your locality. I'm not sure whether it's at a county basis or a state basis, but I can get back to you all with an answer.
Sir, if I could, and it is,
Yeah.
this is Houston Bruck. I work for Administrator Ducheneaux and just wanted to validate for you. You're exactly right. It's at that local level, as you shared, Administrator, at the county level, and that's statutorily set, sir.
Great. Thank you so much, Houston. Another question is, how can producers provide feedback on this rollouts, or who can they contact to provide that support or feedback?
Several different ways folks can provide feedback. My email's on the website. I read them all. I get back to them as I can, and I share them out with the team. There's also a formal comment process that goes along with this rule, where you can go to the Federal Register and formally submit a comment if you have a suggestion about the rule. And if you have suggestions about things that you think we should do better, feel free to reach out and share those solutions with us as well. We're really leaning into the feedback from producers. Secretary Vilsack told us very early on, go out, listen to your stakeholders. Don't just sit and hear them, but listen and implement. So we've been very conscious about that, not only in farm loan programs, but in the improvements that many of you have seen in our standing disaster programs.
Great. And we're going to share out that link in the Federal Register for public comment. And also we will include that in our follow-up email when we send that to you all. And then there's some questions here also specifically about office locations, maybe where to find your local FSA. So we'll include those directive links in that email as well.
Yeah, there's a pretty good office locator on the website at farmers.gov. And, you know, want to take just a minute, if you don't have another question, to talk about some of the enhancements that we've done there, some of the enhancements that are to come on farmers.gov. We do have an online application portal now. It's on our side of the level 2 EOF, because accessing that loan application creates a record for you. So you do have to come into the office, get the level 2 EOF, and to be able to fully use it. So that's a significant enhancement. Another enhancement that you've all probably heard me talk about in the past is we've taken the basic application from 29 pages down to 13. So all of these changes that we're making are really about trying to make our programs more accessible for producers, streamline processes for our staff, so we can get to more timely decisions on your behalf to get you the capital you need to operate.
Great. Thank you so much. So I dropped the Federal Register link in there, and I'm working on the link as well to the office locator, so I'll send that to you. Any other questions or any other comments from any of our other panelists here today? So I do have a question here that came in. If someone has been told that they were unfinanceable in the past, how can some of these rule changes maybe help them become financeable in the future?
So that's a really good question. And it leads me to something that I like to try to advise all of our producers. Anytime you have a verbal conversation with someone on our team, you have at your fingertips now the accountability tool that your parents and grandparents and great-grandparents needed. You have the ability to email that individual and say, this is what you told me. You told me I was ineligible because you don't do beginning farmer loans. And then you create a record. And our staff either have to correct the record or be held accountable for what they said. So use the opportunity to communicate via email with our staff to ensure that you heard them correctly and they conveyed what they wanted you to understand. Because oftentimes I'll give you an example on the farm program side. We'll have a producer come in and say, hey, I need a program for a disaster I'm having with my goats. And our staff will say, we don't have any goat programs. And they're not wrong, but they're not exactly right either. And if the producer would follow up, I asked about disaster programs for my Nubian goats. You told me you don't have any programs for me. Is that correct? The staff member now has to either accept that as what they conveyed or correct it and say, well, we don't have any goat programs. We do have disaster programs. You're eligible. Here's the forms. There's been in statute a receipt for service tool that has been required by Congress, but that predates the ability to just email what you think you heard the loan officer or the program officer say. Use that. If you don't have a computer, use one of our cooperators who has a computer and say, hey, I talked to the FSA and they told me this. I want to make sure I get that record built. It could very well be that you may be ineligible due to debt forgiveness because you have reached your real estate term limit or for some other reason. And coming to a fuller understanding of why that is helps us continue our work with regard to policy improvements. It's stories like that that led to another of the legislative proposals, that is eliminating the ineligibility for previous debt forgiveness after 7 years. So having all of that feedback is really critical to us, because while we have a chance here, we want to continue to move our sphere of influence out into the world and get more producers in.
Great, thank you, Administrator Ducheneaux. One last question that came through is, do any of these changes impact youth loans?
Youth loans are pretty well defined. Houston's going to jump on here and correct me, but did we increase the amount for youth loans in this rule?
Yes, sir. The youth loan limit had not increased since 1988. It's been unchanged. I think we know a little bit about inflation since that time. We've increased that limit from $5,000 up to $10,000. No other related changes, sir, to the youth loan program.
Yep.
Okay, great. So with that, unless there's any other final questions that come through, just as a reminder to you all, if you have registered for the webinar, you will receive an email. But I want to extend our gratitude to the FSA team, Administrator Ducheneaux, also our partners at the Native Agriculture Financial Services, and all of you for joining this webinar, just to help us not only get the information out there, but as well as support producers in the best way we can. And Administrator Ducheneaux, go forward.
You bet. I just want to thank you all. The feedback and the work that you all have done for the last however many years you've been doing it have informed this rule change and continue to inform our efforts at credit reform. So we really appreciate having that ongoing dialogue. We appreciate the work that our pioneering organizations out there in the CDFI and OFI realm are doing. We really look forward to having those partnerships grow and mature and be able to amplify our mutual benefits to producers. So thank you all for the good work you're doing. Please don't hesitate to reach out at any point in time. Drop me an email. Whitney, we will send you the legislative proposals and we'll take a look at what training materials we can share with you all so that your ecosystem of folks there have it as well.
Wonderful. Thank you so much. And Administrator Ducheneaux, do you mind if we ask one more final question and then we'll close out for today? It's another specific question. Are there any adjustments in the provisions that required a 3-year documented experience for the loans? Because in this person's experience, they were told that they could not get a microloan unless they had experience.
If they were told that with regard to a microloan, they might have been misinformed. And this is where that accountability measure that you have takes place. Email them. You told me when I asked about a microloan that I needed 3 years of experience to do that. That's not entirely correct, but one of the legislative proposals is to totally eliminate the management experience requirement for farm ownership loans if you have a mentor that's approved by the secretary. That could be a mentor at the Native American Ag Fund or at NAPS or at one of your CDFIs or other nonprofit. You have a mentor, we can waive that if we get that legislative proposal passed. As it is right now, as long as our staff can document in the record that you have been party to management decisions on that operation, we can generally clear that threshold. But again, then it's incumbent upon us as producers to be able to articulate, yeah, I was picking the bulls. I chose when they went out. I picked the feed for our family operation, so that our staff can get comfortable in that they've documented that management experience, because our staff don't want to lose their loan approval authority for the other folks that they're working with. So good question. Please email me if you still have the needs for a microloan.
Thank you, Administrator Ducheneaux. And Tony, I will send it over to you for final and closing thoughts.
Well, Zach, stay tuned because I'm going to ask you one last question. But I just wanted to also, again, commend this administration and those that don't know, this is the most diverse group that has ever existed of appointees in any administration. I look at USDA alone, and I'm so proud to see so many diverse groups, females, operators, those with lived experience, Native Americans, and the voices that they bring to this space has been very impactful. But I want to end asking, what can we do as nonprofits, as tribal governments, to continue this work? The call to action per se, we look at Native Ag Financial Services as another big part of the solution that we're bringing to the original Keeps Eagle claimants, another avenue of funding. But what can our organizations and entities do to help in this space, knowing that many of us are nonprofits and we have a role we can't lobby, but we can educate, and many of us work with tribes who do have lobbyists. So what are some things that we can continue to do that you can let us know today? Call to action.
Again, I'll reiterate, I can't stress enough how important it is that this administration has taken the proactive step towards credit reform to include those legislative proposals in the president's budget, because that lays out the vision from the executive branch for policy change, which allows us as executive branch members to talk freely in the open about them without being in violation of the Hatch Act. It gives you the tools you need to go, if there are things there that you approve of, to say, here is a legislative proposal offered by the Biden administration that we really support, and here's why. Here's the education about why. Us laying that framework out there for you all to consider is really a critical step in being able to better advocate for the changes that we need to really institutionalize this for generations to come in statute.
Well, thank you everyone for participating today, and be sure to register with the Native American Agriculture Fund. If you haven't, we provide a lot of helpful information, not only that we provide through our financing and through our funding, but also our partner organizations and important information and press releases from the Department of Agriculture and other agencies and departments that impact Native Ag. We would like to let you all know that you can access this recording and also the additional video. There is a 3-minute video that FSA has regarding these changes. And if you have any suggestions or comments, know that these go to the department directly, but we can help facilitate along with our other organizations, the Native Farm Bill Coalition, the Intertribal Agriculture Council, the Indigenous Food and Ag Initiative. We're all working together in this space to make sure that your comments and questions or concerns are addressed. And if you need assistance with that, you can reach out to any one of our organizations and we'll make sure that your voice is heard. So thank you all for participating today. Whitney?
Thank you all
Thank
and
you all.
have a great day.